Hello.
Hello.
Hi, I'm Kumar here. Can you all hear me?
Yes.
Can all of y'all hear me? I'm Kumar here. Hello.
I can hear you guys.
Right, okay, that's great. Actually, Anju will join us halfway through. She's having some technical problem, but she has asked me to just take up this session. So may I know who and who are present here today just now? Anand?
Yes.
Panika?
Yeah, Anand Panikar, Anand Ramanathan.
Yes.
Yeah, then Anaino.
Yes.
Yes, then who else? Gamage, is he there?
Yes.
Right. Neil, are you there? Nilant?
Yeah, I am here.
Yes. Yes, good. Satyamurthy? Yes. Vinod?
Yeah, I'm here.
Right, great. Okay. So, let me welcome all of y'all. Anju will join us in a couple of minutes, but I'm recording the session, so you will have the recorded version also as we go along. So, we are basically with this case study. I know it's a revision class, what we are doing here on this case study. So, can you see the screen? Any of y'all can see the screen? Can you all see the screen?
Yes.
Right, okay. So basically, I just want to discuss few things on the case study from the F3 point of view. Now, if you really look at this case study, couple of things that probably you know already. What do you think about their gearing about this particular company? What is gearing, first of all? When a company says they are geared 20%, what does it mean?
The ratio of their debt over equity is 20% of the total capital.
Yeah, in other words, what it says is out of your total funding, 20% has come from debt capital. That is what it means when you say gearing is 20%. Now, any one of y'all have done a little bit work on this pre-sale to find out what is the present gearing of this company. Look at your financial statements, very important.
Around 16%.
Yeah, right. Very good. All of y'all are agreed 16% is the gearing?
Yes.
Yeah. So that is a book value. The gearing is 16%. Remember, because we have not been given the market value of shares. If the examiner might give us market value of shares later on, in that case, we may have to work it out on market value. But on the book value, when you are working out on book value, you have to work it the share capital plus revaluation reserves plus retained earnings and loans. What do you think in a company when you say gearing is 16%? What is the implication of that one for you all? Anything that you can think of when you say 16% gearing, what is the implication that you get, or what's the understanding you get looking at this case study?
It's a fairly, good company. Basically, they don't rely much on loans.
That's a good thing. Yeah. Rather not that they don't rely on much of loans. They right at the moment their dependence on loan is very little. Not that they don't like it, but rather at the moment the dependence on their loans is very little. In other words, the good news is for expansion, they have fair amount of facility in financing through the loan. Agreed? That is what you need to know from this gearing part of it. So this company, if you remember, they are a company that is really thinking of going for expansion. How do we know? Because in the pre-scene, they say they want to invest in new technology. Right at the moment also they have invested and they want to invest more on new technology. So if you want to invest on technology, that means you need money. How can you fund a company? This is a listed company. So one way of funding is the equity capital. Correct? You can go for shares to the market and raise money to equity. That's one way because this is a listed company. Second way, you can raise money through debt capital. Already they have a little bit of debt, 16%, but you have a fair amount because up to about 40%, it should be all right for gearing for any company for that matter. So that facility is there. What is the third way of funding? Any idea? Third way of funding. Third way is your own fund. Own fund. You have 1,186 or 1.1 billion in your financial statement of financial position. The funding that is available already. That is what we call internally generated fund. There's 1.1 billion. But you have to remember, you can't spend the entire 1.1 billion, the money that is in your hand, for expansion. Because you need money for many other things. So you have to work out a cash flow statement and decide how much of cash is available for investment. So if you look at the word company, the first way of financing, you should look at the cash and cash equivalents. But you can't take the entire 1.1 billion. You must look at your future commitments, prepare a cash forecast, and see how much is available. What's the next option available? What's the next option available? Do you go for debt or will you go for equity? Any idea? Will you go for debt or yeah? Yes.
But here in this case, since the taxation is not in either country, since the profitability of this industry is not taxable, so debt will not have any extra advantage.
Right, very good. I think that's a good point that all of you all can note it out. Normally, the debt has advantage because it is tax deductibility. Number one reason why it has an advantage. But there's another number two reason why debt is advantageous. Generally, debt is less risky from the investor's point of view, and therefore the return that you have to pay will be very much less than what you have to pay for equity. So always equity is more expensive. Always equity is more expensive. That from that angle, you can agree with me that debt is still cheaper, even though the tax advantage is not there, which is a good point. But still, for all, debt is cheaper for the company, and this company will have capacity to raise debt because they have just 16% gearing. So my priority, as far as this company is concerned, if it is coming for gearing, it will for funding. First of all, look at the internal funding, the money that you have. So that's the number one. So look at internal funding. Number two, look at your debt funding capacity, debt funding available. Number three, equity. So this is the form that I will go through, because the moment you raise equity, your earnings per share can come down. There can be other problems that's happening around. So you probably don't want that to happen, and maybe this is the route that you will take as far as this company is concerned. So what I said was, basically in your F3 point of view, there are three decisions that is involved. One is the investment decision. Number two is the financing decision. Number three is the dividend decision. I want you to draw your attention to the dividends of this company. Look at the dividends what they have paid in the last year. Look at their statement of changes in equity and see how much dividends they have paid. They have paid a dividend of 3,828 as a dividend in the statement of changes in equity. We can see when they were earning a profit of 4470, they have paid 3828 as a dividend. So that's another thing I want you to note it down. So the dividend ratio is fairly high on this company. 3828 to 4870. So one thing in a dividend matter, what you have to think about all the time is, can you sustain the dividend? What they have paid it in the earlier. So you can see this company has paid a dividend of 3828 over 4870. What is the percentage of dividend this company has paid? That is what we call the dividend payout ratio. 3828. How much?
6. 870 or 44?
Yeah, it's about 78%, isn't it?
You know,
Exactly, 70%.
It's about 80%. Right. So what does that tell you? Last year they have paid a dividend of almost 80%. So now you have to see why they paid it, number one. Second one, you have to say why they have paid a dividend of that amount. And then the next thing what you have to decide is, can we pay a dividend like that in the near future? So dividend is something but you have to be very sustainable, whether you can pay a dividend of that nature. So you probably, why do you think they have paid such a big dividend?
See, I have a question.
Yes.
My question is, now let's say that Wood goes for debt.
Okay.
It would still be a disadvantage for Wood because going into debt is not going to be a major advantage. Because since there is no tax on debt, the reason is if I take more debt, the risk profile of the company increases. And after that, my shareholders would want more return.
Yes.
So,
agreed. Totally agreed. Yes.
So I would say
you're right.
Debt and equity are on the same level.
Yeah, you know why debt is cheaper than equity? Debt is cheaper than equity for two reasons. One is the tax implication. Second reason why it is cheaper, so always cost of equity is higher than cost of debt for two reasons. One is the tax deductibility, which is not available for one. But the other one is always equity is more expensive than debt because equity is considered more risky. What you say is perfectly correct. When the gearing goes up, the cost of debt will go up. If you remember the MM theory, it says the risk won't go up. But the traditional theory says after some time, the cost of debt will go up. After some time. Always the cost of equity will go up. Always the cost of equity will go up. But the debt cost will rise up. But immediately, if you really look at it, is still cheaper. Are you in agreement?
Yes.
Tax deductibility is one side of it. If the company was taxable, surely debt is cheaper. But even otherwise, the debt is cheaper still purely because less riskiness. So since the company is 16% geared, we have enough room to go for gearing. So that's a good thing. And another reason why I say the debt, you can go for debt. The second reason why I say why you can go for debt is look at their non-current assets. Look at their non-current assets. They have huge amount of non-current assets. They have something like 23 billion on land, 25 billion on biological assets, and a little bit of plant and equipment. They have 48 billion worth of non-current assets. So they have enough collateral security to be given to get a loan. When you give collateral security, the loan will be less costly for you. Because from the lender's point of view, less risky for them because you have enough collateral. So these are the plus points this company has to go for lending, for debt capital. Still, I believe...
Kumar, hi, this is Andrew here. I managed to join. I joined
All right, yeah, Andrew. Great. Okay. Yes. Right. Okay. Yes.
I think when you mentioned to the students, in the sense you said that the debt capital is cheaper, because of the risk component. I think with the 48 billion assets, there's an asset backing of 48 billion. So obviously, it's kind of, that is one of the factors that's driving the riskiness of it down, isn't it?
Yeah, right. Because they have enough collateral to be given to raise loans, which can, and also with their gearing factor at 16%, they are surely in a position to borrow at cheaper rates. The financial risk is less for them at the moment. Gearing is riskless, and also they have enough collateral, which will mean they can take loans at cheaper rates. Only thing what they don't possess is the tax advantage normally other companies have, because this company is not paying taxes.
One thing is that there is no tax advantages, but one thing, debt, since the asset value is more, the debt will be cheaper than in other cases. But one thing is there, debt is an outside liability. If the loan has to be paid, they have the preference is more than the equity shareholders. So in this case, the risk perception of the debt is more than the equity.
Why do you say that one? The last one I did not catch up what you said. You said that when the debt is taken, you have to repay. Is it?
Yes. If the lenders want the money immediately, you have to pay it.
No, you are not going to take money from lenders on short-term basis. You take money from the lenders on long-term basis. I'm not talking of the short-term, immediate kind of repayment. You try to do, you remember on financing, we have another factor, the matching concept. Long-term assets should be funded with long-term funding. Short-term assets should be funded with short-term funding.
Yes.
That's a really, really very important aspect that you just brought up, the matching concept, because what you, especially in this case, you will be going in for a long-term funding because it's a long-term project.
Exactly. Because the forest management projects are generally long-term projects, and you go for long-term funding. Of course, the long-term fundings are much, much more costly than short-term funding. Short-term fundings come at a cheaper rate because less uncertainty. Long-term funding comes at a fairly higher rate because of the more uncertainty.
Yeah.
These are the factors that you decide when you want to fund a project. How long do you require? If you require funds for 5 years, you don't want to fund it with a 10-year loan. What are you going to do after 5 years? You have to pay interest, but you don't have money. Yeah, Neil, you say about the interest cover. Interest cover will definitely come down when you borrow money, but may not come down because you are going to invest in new projects, which is going to bring you a higher return.
Again, the last few years were not that much fortunate for the company. So, will it be expecting that interest cost will be higher because of that reason?
Interest cost may not come up that way. It all depends on the future forecast and the future of the future project. The shareholder funding can be more costly because since they have not paid any dividends for the last couple of years, this is the first time that they have come up with a fairly big dividend. The equity may be much more costly. And I'm sure probably they are trying to put up some kind of a higher dividend payout to get a good signaling effect on the market, maybe for latter stages. Because what
you're saying, Kumar, is so the reason that they've paid out such a big dividend is that sending out a message to the shareholders, isn't it? Because
that the company is doing well. That's what we call a signaling effect, because the only way the shareholders come to know that the company is doing well or not is the dividend signal.
Right. Okay.
Even
So
though
this is
even though you and I will do a lot of analysis, most of the shareholders they only come to know the dividend signal. So the generally if you have been paying a dividend and if you stop a dividend, the signal in effect is that you are not, the company is danger to bankruptcy. If you pay a
And this is
dividend and reduce the dividend, it says
Yes.
that the company is in financial distress.
And this is a technical term that can be used when you're writing your answer.
Yeah. Yes.
Could I
So all this.
add one point?
Mhm. Yeah.
Hello? See,
Sure. Come.
see, the industry has been going through a tough time till recently, and it did
You're
not
right.
make sense to funds in the business or in the industry right now. So,
Yeah.
the way the share market looks at such a company is that first thing is I have excess cash and I don't know what to do with it. So the
Okay.
share market could continue that as the business is entering into a plateau. So
Right.
the only way to come out of it is since I don't have anything else to do with my funds, I might as well return those funds back to the shareholders.
You're right. Normally, that should have been the way. That is for a company that is not having any investment project. But the forest management companies is not that kind of a company. We are not looking for something in the short term. It takes time, and after some time, it will generate profits, and you should be able to generate these things. It are long-term projects. The first couple of years, the oil industry, forestry industry, those kind of industries will not generate too much of profits. After there have been some uncertainty, but what you can see the positive side is the government is backing them, lots of advantages, very high margins. One thing you would have seen in this the case study is the very high profit margin. The GP margin is very high, profit margins are very high. So the moment it starts generating, it's going to generate it at a very high level. Right, agree? Yeah?
Yes.
Okay.
Right. So basically what we are trying to say is, okay, this company has some unique advantages, low gearing. It has a kind of a disadvantage in a way, no taxes, that is for the debt deductibility, but it has a big advantage. They have big profits because they don't need to pay taxes, very high margins. They already have about 1,000 million, but my gut feeling in this company, you may be asked to prepare a cash flow statement. They may give a cash flow statement where probably you may run into some short-term cash deficit. In that case, what are the probabilities of raising money? So someone asked about the short term. Short term, yes, we can go for a bank overdraft or something like that. They have enough collateral, no need to worry. They can do it. They may have a short-term funding deficit at the time. Also, in that case, one other option is they may withhold the dividend. They may defer the dividend. But that may not be a very good strategy because they have just started paying dividends. And again, to withhold the dividend can give some kind of negative signaling effect to the market. So I would say short term, you will go for some short term borrowing. On the long term also, after looking at your cash, what is in hand, the bank, because the cash what you have is actually not too much when you come see the dividend what they have paid in the last year. Not too much of money, right? So you will see that even though they have 1 billion, which is big, but you can see on the other side, the trade payables itself is 1.3 billion. So I don't think they have so much of excess cash in hand at the moment. In fact, I believe they might have a kind of a cash flow deficit at one particular point. So these are the factors that I would like you to note it down in this case study. I just want to quickly look at one thing what I can see in this case study is, probably they might, initially, if you remember, they had some shares, and then after that, now they have issued shares. They might think of these forestry management companies, generally, they have a tendency to have a major shareholder. Not a controlling shareholder, a major shareholder. Some other competitor company holding some big percentage of shareholding. So the mock that I have put it right in front of you is a similar situation. We have another company holding 25% shares in our company. Now, you know, 25% of shares generally will not give them a controlling interest. What kind of an interest it will give if some other company sold in 25% in wood, what will be the nature of interest they will have? Another company sold in. We generally say if you have only 50% plus, then you have the power and control. But if you are holding about 25%, what is the kind of a company that we call it? If some person is holding 25% in your company. Any ideas you have? Yes, I'm going back closely held.
Minority interest.
Minority interest.
No, not a minority interest. 25%. Yes, it's right. It's a minority interest, but it's something more than a minority interest.
Associate.
Yes, that's correct. That's right. Great. It is an associate company, right? So if some person is holding 25% in my company, that company becomes my parent in a way, and I become an associate. So now in our company in Wood, some person is holding 25%, just like this mark they have given. Tim Wood, another multinational company, they have acquired 25% some time back. Not today. Out of our total shareholding, 25% is concentrated in one particular hand. And that's a multinational forestry company. And recently there have been a kind of a newspaper clipping where they talk about this Tim Wood holding 25% since 2013. And at the time that, you know, when a company takes 25% kind of a control, or not a control thing, but we call a significant influence. So remember the term, significant influence. So when a company has significant influence over us, what is the next step that you think? Imagine you are a shareholder of one. Some other person is holding 25% in your company. What is the feeling that will go through your head? They have a 25% interest. They have a significant influence. And they will have a representative in the board. You are right. They will have not one, they may have two board directors. Right? But when you have that kind of a thing, what is the next step that generally they will try?
There could be a conflict of interest here.
There could be a conflict of interest. That's right. And that is why it says, someone said it's a related company. You have to disclose the interest here. There will be definitely a conflict of interest because it's another forestry company holding 25% in your company. And the next thing that they will do is they probably want to go for a control. If you have the 25%, the human nature, the business nature is such, they will not be happy. Next thing, they want to go for a control. So in 2013, when these people, this our other company, the multinational company, when they acquired 20%, our company directors have had a press meeting and they have told us that, you know, probably they would have told it's only an associate. We have become their associate, and unless something materially changes, we will not comment about it. So the only thing that can materially change is probably they take in the control. So 2013, 2015, nothing has happened. And now the board is asking you, I want you to look at this question. How might the presence of Tim Wood, a 25% shareholder, affect our decision making as a BOD? Perhaps surprisingly, we have never had a formal discussion. So someone said there will be one or two members of their people in our board. So when it comes for the decision making, what impact it will have? And how will wood timber stake in wood affect our share price? So these are the two tasks that we have to do it in about 1 hour's time. So let's pick up some points what we can look at. And also look at the press clipping that was there. yesterday's announcement of yet another forestry project by what should keep everybody happy. So surely you are a shareholder, I am a shareholder. When we know that our company is entering into a new project that is going to keep us happy. Nobody will be happy than the directors of Timwood. Obviously, because they have a 25% interest, so they will be very happy when the company has successfully invested in a good project. Whose continuing ownership of one part of shares continues to confuse industry insider. And someone said there's a conflict of interest. It's much more than a conflict of interest. When another competitor is holding 25%, a multinational company, you always have some kind of a confusion. You remember multinational. What do the multinationals do? What is the advantage they gain by holding some big shares in another company?
They have international exposure and experience.
They have their international exposure and experience, you are right.
Which what can use for its own expansion.
Good, very good. That's another good thing, yes. And also you remember the multinational term always rings you a bell. What is the bell that is going to ring? The tax, it could be called tax misuse or tax abuse in a way. You can use the transfer pricing to reduce your tax. Surely right at the moment they are not controlling, they may not have that kind of a controlling element, but still for all they may be able to do certain things. So this is where the industry is somewhat confused why these fellows are holding 25%. My gut feeling is the industry is thinking one day Timwood will take over Wood or take the control. The moment they take the control, they will have influence over dividend decisions. They will influence over pricing decisions. Not the influence, they will have control over pricing decisions. They can use it for tax advantages, that kind of a thing. So that is why they say perhaps there are hidden depths to the relationship between wood and timber. So these are the key words that can tell you certain things in this treatise. So now I want you all to think about this part of the question. This is a real examination question. If you were to answer first part, how might the presence of Timwood at 25% affect our decision making? Imagine you are a director of Wood. Imagine all of you all are the board of directors of Wood. You have some fellows also of this 25% interest. How it will affect your decision making? Let's think like this. What is the board of directors' objective all the time?
Would not have direct control, but board of directors will concern that they are reappointment at the time of the AGM.
Huh? Yeah, that can come up because these people are holding 25%, but so long as the other 75% is with me, I may not have that much of a fear. Of course, I have to be fully aware.
The board of directors, their primary aim is, to be to give the best return of investment. Basically, the company's objective. They have to ensure.
Yeah, right. Yeah, right. That is to maximize shareholder wealth, isn't it?
Right. So
age-old tradition is to maximize shareholder wealth. Very good. Yes. Yes.
So going along the same lines, we don't. There might not be that much of an influence. For example, the shareholding of Timwood on Wood is 25%. There can be a situation where Wood could enter into a project where the directors would be under pressure to hand over that project to Timwood instead of Wood taking it directly. So the concern out here is, looking at, these are the negatives, but the positive aspects could be that some of the projects would be having, which Timwood would have, could come over to Wood also. Wood has the experience in MLAN, and Timwood does not have it. So
very good.
So the exposure that, or Timwood, Wood could be a very integral part of Timwood also.
Right.
So there are advantages and disadvantages, but having looked at it, this is pretty common in pretty much all the industries. There are
Right,
companies
exactly.
that have shareholding.
Exactly. What you said is basically correct. It is very much common. Now, this is what the CIMA is going to test you on a common aspect like this. So, my feeling, whether we have a 25% hold held by one person or 100 million, 100% held by 200 people, it does not matter. Our objective as a board of directors is to maximize shareholder value. So it may not really matter for our board decision because our decision is always to maximize the shareholder value. So whether it is concentrated in one single hand or whether it is concentrated in few single hands or whether it is in many hands, it will not have a major impact on our decision making about making shareholder wealth maximizing. However, having said that one, if a company is holding a controlling interest, it will have an impact. But here, no one is holding a controlling interest, and therefore we will not have that much of an impact. Having said that one, we will have to be fully aware a 25% shareholder is a high power, high interest shareholder. Mendele's matrix, high power, high interest shareholder. They have invested so much in our company. 25% of our company is with them. So therefore, we will not have the same freedom because to make our investment decisions, they will be too much caring about our investment decisions. It's not like many, just 1%, 2%, many shareholders. When you have a 25% man in the board, he will be very, very concerned about the projects what is going to be done.
Kumar, this is Andrew here.
Yeah, Andrew.
Just an idea and just a thought, and this thing happened in one of my previous organizations as well. So, for example, I worked in a company called MBF in Australia.
Yeah.
And Bupa, Australia, was a very, very small company.
Yeah.
Right? Both were in insurance. Okay.
Right.
Now, MBF was a major player in Australian insurance.
Yeah.
But what happened was Bupa was a multinational player, and they were always eyeing a big player in Australian market.
Okay.
So it could be these guys, the Tim would be somebody like that. It may be. The agenda might be very different, isn't it? It's not just a 25%. They might be thinking, because it is a multinational company, so therefore they might be thinking of coming into this market.
Mm-hmm.
Right? So it's a good way of entering the market.
Yeah. That is true. That is why they have told in 2013, if there is going to be any big changes in the relationship, we'll keep you informed. So far, nothing has happened to make our mind change on that one. So you can see, actually, that is the real hidden agenda, Andrew. Right? But what they say is, so far it has not happened.
Yes.
Right? And that is that is where the student, we have to be intelligent enough, just like what Andrew said, to be aware of the hidden agenda. So far it has not happened. But even with a 25% interest, they will not, not like just small shareholders. The board of directors will not have the entirety of freedom because these people will be looking at our investments with an eagle eye. So we may not be able to maximize the collective wealth without considering the Tim Wood's interest in our company. Someone else said, yeah, sure, yes. Yes.
Please, if Tim Wood is having an option to take a business, the directors will be having, seeing the 100% of the revenues will be going to that company. If both are in the competing industry, will there be a bias to take the business to the other side?
It's not bad. It always happens. It may be because the Wood other shareholders may want to sell their shares provided they can get a good price. Why not? Lot of takeovers are taking place all over the world. Ultimately, the board directors will have to think in the interest of the board shareholder. If they can get a good price, they might say yes. They might recommend to hand over your shares to those people. That can happen. That is how the takeovers do take place. Of course, if the board directors feel that it is not a good deal, then it will be a hostile takeover, and they might advise the shareholders not to take it, not to go for the thing. So they will have defenses of takeover, like put it up a Knightwood, that kind of a situation. But here, it's not a bad thing. A company taking over another company is not a bad thing. But of course, you have to look at from many angles, like the monopoly. Here, there is no question of a monopoly arising, because this is an industry of a forestry industry. No one can dominate it, so it doesn't matter. And also, so long as your shareholders are going to get a good price, why do we hold shares in a company? We want dividends, and but in the other way, we get a return. Capital gains, isn't it?
Okay.
Capital gains. So if you can get good capital gain, why not? It's perfect, all right. But here, we have to realize we have not come to that stage. We are not come to that stage. There is no takeover happening at the moment. So only thing, as a board of directors, we have to be fully aware of this 25% presence, and they are also in the same industry, and therefore there will be conflict of interest. Of course, you must remember there can be lots of synergy. You can get there, someone said, you can get lots of advantage, expert knowledge from their point of view, the way they manage. That can be a very positive help, which you may not have otherwise. Their directors may be able to tell you certain technology, but they use, which others will not have it. So there's something called synergy, which can arise from this company's 25% interest. So, but ultimately what will happen is, it will definitely will create an incentive for us to deliver steady growth with no visible risk. Right? There is no visible risk, because so far there is no particular kind of a threat of a taking over happening. On the other hand, when you have a 25% kind of a interest with another man, our board of directors may be somewhat very conservative in their decision making. Subconsciously, they feel there is a big man holding, and they might be very, very conservative. They might not take too much of risk, normally what they will take it. And also, our decisions will be somewhat complicated, because he is a competitor. So we have to be looking at the best interest of our shareholders, which includes this man, Tim Wood. And also, we have to ensure that we don't allow any room for them to take advantage of our decision. You know, when they have a board, they have one or two directors, they can always unethically, I'm coming to ethics in here, unethically get that inside information and work into some of the potential projects for us. They can advance and do it. So unethical things can happen. We have to be fully aware, because the business is business. You know, people will try unethical things. Not that we endorse, not that we condone, but we have to be fully aware that can happen. So these are the factors that you might want to discuss as far as the board of directors are concerned, when you have another person holding 25%. I want to look at the second part of it. What will you think about the share price? What will happen to the share price? Right at the moment, they are holding 25%. What happens if they decide to sell their 25% in the market? They can decide to sell it. You know, so
there will be
whatever the
pressure
reason,
on.
they will be.
There,
Yeah.
I mean, as Neil mentioned, I mean, it will be, it will be as if there is something wrong with it, and there might panic might set.
You're right. You're right, because when a multinational decides to dispose their stake, there can be a kind of a signaling effect to the market. Oh, wow, the company is not doing well, right? They are selling shares. So the share prices can start tumbling down very, very rapidly. So that can be an implication that can happen. That can be a consequence that can happen, because if them holding 25%, they can use it to trample the share price. It can happen, right? Of course, it all depends on the communication to the market. You have to remember there is something called market hypothesis. You remember the three market hypothesis? Semi-strong, strong, and weak. Semi-strong, strong, and weak. When the company makes certain announcements to the market, sometimes the market don't react at all. That means it's a weak market hypothesis. So that means that market is basically going by history, not by present or the future. Sometimes, and most of the time, the market is a semi-strong. The moment you inform, the market reacts. And that is what we call semi-strong, and that means the market is responding to current information. Sometimes the market is so advanced, they have already reacted even before the information is out, and that's what we call a strong market. So that means they have reacted even for the future information which is still not come up. So here also, it all depends on how the communication will be from Tim Wood's side. Are they saying they are going to sell it purely because, you know, they are no longer interested in wood? Or are they going to say that they have some other strategic reason and they are selling it? So all that can have an impact upon the share price. So the Tim Wood will be regarded as a kind of a source of news to the market. The moment the way that they behave in the market can have an impact on a market. Then on the other side of it, it can stimulate the share price, because always there's a possibility with this man holding 25%, they will go for a controlling interest. So far it has not happened, but it can happen. So that means there can be a kind of a controlling interest coming up all the time, and that can stimulate the share price up all the time. So far they have stated that they have no interest, or rather nothing has happened so far to make it, but it does not mean that they are under any formal obligation to refrain from going for a controlling interest. So the other shareholders will know which Tim would hold in 25%, they might be interested in my shares, your shares, and that they will be prepared to pay something more than the market. You remember, in a listed company, if another company wants to take over those shares, they have to offer something more than the market price. At least about 20% premium over the market price, then only the shareholders will be attracted to dispose their shares. So the other 75% shareholders, or some part of the shareholders of the 75%, will always have the feeling one day Tim Wood will make offer, and then we can get something more than the market. So that can make up something like that. It all depends on the other part of the shareholders. Who are the major shareholders in the balance 75%? If there is a major other institution holding, then of course it may not be such a big issue. But if the other people are small shareholders, it can mean a kind of a situation where the share prices can go up. In times of bad news, we have had a bad news time. We are going through a bad period. In times of bad news, there can be a kind of a situation where our directors can discuss with the Tim Wood directors and insist or rather request them to hold on to their shares. Because normally in a bad time, many people would want to get rid of their shares. But we have an advantage here. We have a 25% man. If we can persuade them to hold on, we can kind of have a control over the fluctuation of the share market. He's a major player. If we can keep him holding on to his shares, we can minimize the fluctuation of the shareholding. Isn't it a good thing? It's a good thing, isn't it? So you can see, as someone said, there are plus points and minus points even on the share price. It can come down, it can go up, it can keep it stabilized because of this 25% holding what they have. Any questions that you all have? Any questions that you all have on this area?
Ultimately, on the expectation of that Team would take the controlling interest and offer them a higher price. On this anticipation, the share price will move up.
All right. Always the share price can be upward all the time. If it's a strong market, it may have already gone up on that anticipation. If it's a semi-strong market, it can always go up. The people will be holding the shares. Imagine you are a shareholder. Imagine that share, 75%, what was the need, what was left, you said something just now. 75% won't affect any share. Sale, yes.
Yeah. In a strong market, it will act proportionately.
Yeah. If it's a strong market, always they will get advanced information. Maybe unethically, what we call inside information, or the market is so intelligent, they will analyze and they will know that these fellows are going to buy the balance part. And the share price has already gone up. The present share price will reflect that additional part also. That can happen.
And if it's a weak market, it will not have a marked effect.
A weak market will not take notice of any of these things. It is very, very slow for reaction. If it's a semi-strong market, it will immediately act upon the information and the share prices will go up. So you as a shareholder, in the 75% category, you will always have the hope with your shares, hey, I can always get a higher price than the market price. I will hold on. I know one day Tim Wood is going to take over this company. Tim Wood is a multinational company. They have no problem with resources. They have enough resources. They will take over. So I will hold on to my shares thinking I can get a higher price than the market price, a premium, and that will keep the share price up all the time in anticipation, in expectation. So these are the things that you can have it in this scenario. I want you to, before we finish up this little thing, I want you to, because this is a real question, if you were to start off this part on the people skills, I want to know how you will start off the answer to this question. Of course, surely, this was an email, I think you got it. So you will refer to the email and talk about it. And then on the people skills, look at you are a senior manager in your company, and now your who is your CEO is coming out, your finance director is coming out and saying, hey, my secretary has seen something like that, and we have never discussed this one, and I want your view. Now remember that you are part of this company. What is your immediate feeling about it? You must express that one. That is people skills. As a senior man, now you have to stimulate your position. As a senior man in the company, when your finance director says, hey, my secretary has seen something like this, man, so far we have not discussed this one, but, I want your thoughts. How will you feel? You feel very happy about it, or what do you feel? What is the company director doing? Is he doing a good thing? Is he doing a bad thing?
first thing is this could be a confidential document which might have come. So first thing we would need to know is
it's a press article.
Okay.
My secretary don't attend to the newspaper clipping, so it's no longer confidential. It has already gone to the market. Now, what I'm trying to get at is this. You are part of this company. I'm trying to get at whether it's a E3, P3, it doesn't matter. When you're part of the company, when the director, the finance director, your immediate boss is talking about this matter in our board. Or rather, I would like your thoughts so that I can have a long possible to think about what I will say to the board. So your finance director is going to take up this matter with the board, which had not been addressed all this time. So I believe this is something which you as a senior manager will be very, very happy about. Something which the company has not done all this time, and you are going to discuss it at the board. So I want to start off this mail by saying I'm very happy that you have decided to discuss this matter about this Tim Woods holding at the board meeting. This is the expression of your feeling, and this is what we call the people skill. You have to remember, don't remember this as an exam. I always say, don't think this as an exam. Think this as a company where you are part of the top management. And when your top management is doing something good, you must be very, very happy. If your company is subject to some kind of a threat, you must feel emotionally that you are also part of it, right? On the other hand, if the scenario was they are going to take over more than 25%, and if you were not happy with it, you must be expressing your shock and your dismay over what's going to happen, because we are going to lose our jobs. We have to remember that way. All of us are in business for selfish reasons, right? So we have to remember that we have a situation like this, and that we can have a scenario like that. So here, I'm very happy that my boss is going to take up this matter. So I want to tell him that, I'm very happy about this matter that which we have never discussed at a board meeting, and I want to give my thoughts about it, and you will start off. And you will give all the thoughts that we discussed just now. How will you conclude this one? How will you conclude this one? Remember that you are part of the company, and your big man is asking you some details. How will you conclude it? What do you think that your big boss will feel happy? What way will you conclude it? You must always try to conclude an answer by telling that you are very, very happy to support him on this matter, giving any more information or any more analysis. Try to put that way. That is going to make the things totally, the examiner will feel very happy. You will feel very happy. Remember always to tell the people that you want to support them. So any good thing you must support. But if it is an ethical reason, remember, CIMA is very, very focused on ethics. On the ethical matters, you have to divorce yourself if the company directors want to do something unnecessary. Never compromise on ethics. CIMA is very, very strong on ethical things. So as far as this answer is concerned, that's all I have to say. But before I conclude, I want to talk a little bit about the ethics. What are the ethical issues that probably can come out in a question like this? Any idea that you all have? What is ethics basically? What is basically ethics is?
It's a proper practice of doing business.
Yeah, it's basically the morality. The morality. So CIMA Code of Ethics talks about the integrity. CIMA Code of Ethics talks about the objectivity. CIMA Code of Ethics talks about the confidentiality. CIMA Code of Ethics talks about the professional behavior, professional competence. So in this question, there can be lot of unethical things. Remember this accounting treatment itself is not very straightforward. The valuation of your non-current assets, valuation of your inventory, because they have to use certain subjective measures. Remember what are the assets? They have mostly this forestry assets. You don't,
Uh-huh.
unlike, yeah.
Kumar, sorry.
Yeah,
I think we lost you for about a good 5 to 7 minutes.
Oh, right. Was it?
Yeah, because you went silent. Suddenly we couldn't hear you, and then we lost you. The screen went away, and yeah. So you have been speaking yourself.
No, I didn't know. Okay. Yeah, this is do happen. Right. Okay. So we were, where did, any idea that where we stopped it last, when we were in the screen? I was talking about the share price. Did we see the share price thing? Yeah. Did you talk? I was speaking about the starting the discussion. Were you all there?
Yes, that's correct. You said, you mentioned, what do we feel like, this
Yeah,
price.
that's right. Yeah. So before that, I was talking about the share price, how the share price can come up. The share price, I said basically three things. One is with this man holding 25%, he can come to the market, and depending on the market hypothesis, depending on the type of communication, the share prices can slump. Second one, what I said was, with a 25% holding, there's always anticipation that he will go for a controlling interest, and therefore the share prices can always go up. Third one, I was talking about this man holding 25%, we can persuade him in times of bad times, for him to hold on to the shares so that we can minimize the vulnerability of the share price. Others may want to sell it, but when you have a 25% big man, multinational holding onto your shares, that will give some kind of a steady signaling effect to the market. Look here, the company is not so bad as what we think about. These were the three things that we discussed on you. Any queries on that area?
Yes, that's correct. But then you went on to the next section where you said, when he mentioned to you, what is your feeling? How would you react? What is the people skills of it?
That's right. The people skills, what I said was, you are a very senior manager in the company. Look here, your boss here is going to do something very good. You must feel very happy about it. So you must express that one. You must say that I'm very happy that at last the company had decided to discuss this matter, which was a matter of concern for me also, them having 25% and we not talking about this matter. Something like that. You must express that kind of a feeling, a very, very strong kind of a emotional feeling. On the other hand, if the company was subject to some kind of a takeover or something like that, you want to express your feeling in a very in a shocking way, saying that I'm very shocked that the Timbud is going to take over, which they have never told us, and I'm dismayed about it, that kind of a situation. What I was trying to explain was, this is not, don't think this as an exam, think this is as a part of your life. Remember that you are part of the company. So any good news to your company, you will be very happy man. Any bad news to your company, you will be a kind of a man in some kind of a emotional situation. Express that in your paper. Express that in your people skills. And finally, what I said was, in conclusion, when you are concluding, give that feeling that, you are very happy to support him with this, whatever the analysis, whatever that is required by him. This is what I was talking about. Any clarification you require? Is it clear?
Yeah, it's clear. Fine.
Right. I was just moving on to the ethical stance. As I said, the CIMA is very, very focused on ethics. So I was trying to guess kind of ethical question that can come up on this paper. One problem in this one is your non-current asset valuation. It's not like the normal valuation. You go for history, the historical cost depreciation. We have this biological asset. and the accounting policies is how the biological assets are worked out. Land is shown at fair value, that's no problem. Standing forests are defined and reported as biological assets, are evaluated and reported at a fair value after deduction of estimated selling costs by an independent third-party expert. Once the plantations have been successfully established, the fair value of standing forest is calculated at the present value of anticipated future cash flows from the asset. Now that is where the subjectivity comes up, the judgment comes up. Your valuation is based on the present value of the anticipated future cash from the asset. So here there is lot of room available for the company to maneuver their financial state. Because the valuation is not a very straightforward valuation. It has a subjectivity on the present value. So you may be, as a senior finance manager, your directors might tell you, hey, you know, so and so, we want you to show a big profit because we are going for a big equity public issue. So we want a big kind of a thing, and therefore I want you to overvalue. Now that is not something which you are going to be happy, you are not going to tolerate, you are not going to accept it. Because you are a CIMA professional, you don't want to do that. Because that can be of intimidation, it may be pressurized on you, it may be of self-interest, because you may also be entitled for a bonus depending on your higher profits that you show. Remember, in these accounts, you will see in the financial statements, in the income statement, there's an item called unrealized gain on biological assets. So that's the way that they record it. And here in this case, they have 1.1 billion in the last year unrealized gain. In the year before that, they have 752,000 unrealized. So which is fairly substantial. And if you look at the profit for the year, it's about 25% coming up on that one. So that can be a kind of a self-interest scheme for you. You as an employee may be entitled for a bonus on this basis. I remember I worked in a company in Sri Lanka, and we were entitled for a bonus provided we show the profit. So the profit showing was totally in my hands as the head of finance, and 8,000 people they want the bonus at the end of the year. But my predecessor has always prepared the financial statements providing very low depreciation or no depreciation at all on the asset. And the people are happily getting the bonus, and they were quite happy. The first time when I came, I prepared the financial statements, put in the depreciation, and what happened? It ended up with a loss. And 8,000 people were against me, saying that I have prepared the financial statements wrongly. Not that I have prepared it wrongly. In fact, I prepared it rightly. But they were losing their bonus. And one senior minister told me, why don't you do the way that they want it? Because you're also going to get the bonus. Now that can be a self-interest, self-intimidation. You have to be very, very careful. You are a CIMA qualified person, you are not going to do it. Another area that you can have problems of is transparency, lack of transparency. Remember, these people are fairly unionized. Health and safety matters a lot in this question. So there can be lots of areas of, things happening where you don't want to discuss the matters with the unions, where you want to be somewhat out of truth or out of transparency. Now, in that kind of a thing, if you have been asked to advise, remember, you have to advise to be transparent. Come out with the truthful situation. So in the next mark, you can see there was something about uniforms, and they have subcontracted the uniform manufacturing and of the employees, and the unions have found that the subcontract has done it in a place where they were not practicing proper labor practices, employing child labor. And the response of the directors, or some of the directors or the chairman, was, tell them that we did not know anything about it. But that's not right way, because we knew that they were subcontracting. So the best thing is to admit, accept it, and to take corrective action. So don't ever tread, it may be $1 million, but don't ever tread on the path of transparency. Be of highest ethical standards. This is what the CIMA is expecting. And in our strategic case study, please do expect a ethical question. It may not be very directly CIMA, but always remember you can quote CIMA Code of Ethics. At least you can say in similar situations, CIMA Code of Ethics says this, and go on doing that kind of a thing. That's the way you should be approaching the CIMA, the Code of Ethics part of it. Right. Any other issues that you have, you want to talk about? Basically, what I did was I made few areas on the financials and in the ethical matters within the few time that we have. Any particular things that you want to know, or any clarification in the matters what we discussed today? One thing, remember
Hello?
please.
Hi, I have a question on today's this, but we have to prioritize what we want to answer first, or which issue to take up first.
Yeah.
So how do we decide on which issue is of prime importance? Actually,
here we have no option. What we have to do is, normally in the strategic, you get 3 sections. In the 3 sections, you will find all areas being tested, the 4 competencies, the people skills, business skills, leadership skills, all those things, technical skills are being tested in the 4 areas, in the 3 sections. So what you have to think of all the time, manage your time. My theory is 25% of your time should be devoted to reading and planning the answer. So if it is 60 minutes, 15 minutes, spend it on reading and doing that kind of a thing. Try to figure out the answer in your paper. Then keep about 5 minutes to bundle it out, the closing. So 15 plus 5, 20 minutes gone. So in this particular question that we were looking, for example, 60 minutes, 15 minutes you must take up to plan your answer. 5 minutes to review your answer. 20 minutes gone. The balance 40 minutes, split it between the 2 sections equally. So take 20 minutes, 20 minutes. On the first one, 20 minutes. Second one, 20 minutes. What I'm trying to tell you is, first one, you will have, maybe you think that you have time, things to write for 30 minutes. But please stop at the 20th minute. Don't do anything. Go to the second task, the how will wood affect our share price? Start writing. You might find you don't have too many things to write for 20 minutes on the second one. You might spend 15 minutes. Then you have another 5 minutes. Come and do add it up for the first one, the 5 minutes. Because you are still in the section 1, you are still in the screen, you can do it. So the give equal importance to the issue. That is what the CIMA basically thinks at the strategic level, equal importance to the issue. Honestly, I don't have an answer to tell you how to, in the examination. In the first section, it's all about the people skills, but maybe in the second part. Because otherwise what you will do is you will write on the first part 30 minutes, second part.
Thanks a lot. Thank you. Bye.